Hello and welcome to another edition of 9 to 5 Live. I'm Mark Williams and with me is Francois Savary. Hello, Francois.
Hello, Mark.
Thank you for joining us. Did you have a lovely holiday?
I had a lovely holiday. It was not too warm, it was sunny, and it was very, very nice.
That's lovely. Okay. I think it's fair to say that the events of the last week could be a pivotal moment in investor strategist thinking. There's been a big sweeping change, hasn't there? Um, the first subject I'd like to talk about is Japan, obviously. Next, I'd like to talk about the weak economic numbers in the US last week. And lastly, the Fed. Is the Fed behind the curve on interest rate cuts? Let's go to Japan. Japan is, the Nikkei is down 10% this morning. Um, the moves in Asia are quite vicious, except in China, it's fair to be said. Um, and the dollar yen is down to 143 as we speak. Can you explain to us what happened last week, what is happening now, why this is happening?
The main reason why you have such a huge movement and that at the end of the day, Japanese equity have moved from being one of the best markets around the world since the beginning of the year to become now they are in a correction. They are in a real correction, and you could even argue that after a 20% setback, you are moving into a bear market. The main reason you mentioned is the yen. The yen is the big issue at the end of the day. There was one easy trade, if you want, on the market was the fact that the yen could only go weaker and weaker and weaker, because market participants were expecting that the BOJ would be very cautious in changing course in terms of monetary policy, and there the market was completely wrong, because suddenly we moved to positive interest rates in Japan. You have expectation that the move is just a first move, and that they are going to continue to act on that, which means that suddenly you had a huge appreciation of the yen against the US dollar. It was above 160. It touched the 160 mark, and now we are, as you said, 143. So it means that you had more than 10% rise in the yen. It means that you had a lot of people were financing their investment in Japan through one bet, which was to be short the yen and long the equity market. When you have such moves, both on the currency and on the equity, opposite move, the yen is up, the equity market is coming down, you have some people who are leveraged who need to cover the short. They need really to change course because they need to reduce their loss. And this is a kind of panic movement that is happening on the Japanese equity market right now.
So this is the unwinding of the carry trade that in fact we spoke about a couple of months ago.
Exactly. And I think that we spoke about that a few months ago, about the fact that currency people need to be aware about the risk on currencies and the risk of a return of volatility on currencies, because this is usually something that can disturb financial market quite heavily. And the same thing could happen with the yuan. You know, you had a second carry trade that was very, very much played by the market, which was to be short the yuan, the renminbi, and to be long, for example, emerging currencies. And it's very interesting to see the relation between the Mexican peso and the yen or the renminbi, how they are moving right now. It tells you that markets are really fearing that those moves on currency are going to continue. They need to act. They need to reduce the bet they put on those currency. And that's something that can continue for a while.
The Bank of Japan, they raised interest rates to positive interest rates for the first time in 3 decades. And that has given the market a jolt. Let's be fair. There's obviously going to be some kind of carryover to international markets, not just Japan and Asian markets. Therefore, my question is really: is this a situation that's going to go on for quite a few weeks or a few months? And does the market have to reset its expectations in terms of costs of doing business and investing?
They need to be careful. The investor needs to be careful because, as I said, this move on the yen could continue. The reappreciation of the yen could continue. I hope that it will not continue at the same extent we experienced in the course of the last 10 days, but it can continue. And don't forget that you have a lot of Japanese investors that have invested in the US because they were playing the game of buying US assets and benefiting from the weak yen. So this is also something that could continue and impact international markets, because if the flows that came out of Japan because of the move because of the move on the yen lately, it means that people could have a tendency to amplify the movement by saying, okay, the yen weakness is over because the Bank of Japan is going to continue and to maintain a more restrictive monetary policy. So it means I need to get my money back out of the market because the yen trade is over. So this is a ripple effect that you could have that could continue in the coming week and that you need to be aware. Also, don't forget one thing. What we are also seeing in Japan is connected to something that is also very important and developed in the course of the last 10 days or 2 weeks in the US, which is the fact that suddenly people who were completely sure that there would be a soft landing in the US economy, suddenly people realized that recession could be an issue. And that's also weighing on Japanese equities, because if economic conditions are deteriorating, then you had the double effect. You had on the one side exporter suffering from a higher yen, and on the other side, they are suffering from the fact that there will be a slower economic activity worldwide.
August is traditionally the month of the year where you can have these kind of moves, but they're not always they don't always last very long. It can be transient. I guess my question is really, is this a new trend? Do we have to now start thinking in different ways for the months to come? How long can this upheaval in the market, how long can that go on for? Is this just a blip?
To answer your last question, I don't have any clue. I don't know how long it can last, and but when I see the volatility, the VIX index moving from 13 to more than 23 currently in a matter of few days, I tell myself that the pricing of uncertainty, which was nearly zero a few weeks ago, suddenly came back, and the pricing of risk is again something that people have in their minds. So it can be comforting to a certain extent, telling you that this is a kind of consolidation phase and that people need to reassess the scenario. That's obvious, but it's not, I would say, something that is a trend building for the medium term. What people need to keep in mind is that in a matter of a few weeks, you had different factors that came into play and that were absolutely not expected by the market, and that made things a bit shaky. The first one you mentioned, Bank of Japan, the yen, we discussed. The second one is the fact that Biden get out of the race and put Kamala Harris in front as the candidate for the Democrat Party. This is important because remember that a few weeks ago, you had a lot of players who did what we call the Trump trade. They went long the US dollar, long small and mid cap in the US. They were going short the Treasury bond because they were saying, okay, the bond yield are going to rise. Suddenly, with the Biden-Harris switch, this disappeared. Then you have also geopolitical issues coming into play, because what is happening in Israel and Iran and etc. is coming back in the forefront. And then you have the issue of economic numbers in the US. So at one point, you have this repricing of uncertainty that is coming. Is it going to last? That's the big question. And the most important one is, are we facing really a recession risk in the US?
All right. Well, let's come to the US now. 2 weak economic numbers last week that apparently surprised the market. Therefore, weak manufacturing purchase managers came in 2 points lower than the previous month, but especially non-farm payrolls, which were one of the weakest of the last few years. And is this something that you thought was unexpected?
I think that you have the unemployment numbers and the job creation last week was really a weak number. That's the negative side of what happened in the US. The positive side is that average early earnings are moving the right direction. They are coming lower, which tells you something positive for the inflation down the road. There is also another thing that is very interesting in terms of labor. It's the fact that unit labor costs and productivity move in the right direction in the US. Productivity is improving, unit labor cost is falling. It tells you that if you judge the full labor market, it's not that bad. Moreover, it's one number. Never make too much out of one number. We had, yes, 114,000 job creation. It was weak, but it was just one number. We need to see in August if those numbers are confirmed or if it was a blip, because you had this issue in Texas, you had some job loss in Texas because of the hurricane and etc. So don't make too much out of the number that we had on the labor front. When it comes to the ISM, yes, it was weak. It's something that people need to take into account. This is the reason why I believe the fact that market participant repricing the Fed cut prospect is interesting. You had some people now telling you will be at the last 3 meetings of the Fed, there will be 3 cuts. The divergence is between those who believe that it will be 25 basis point cuts, and you have now some banks telling, oh, no, the Fed needs to go 50. I think it's too early to say that they need to go for 50 in September.
All right. Well, let's come to the Fed now. So you've just said that some market participants are talking about a 0.5 point drop in interest rates in September. You've just said that you think that's too much. Do you think, therefore, you do not think that the Fed is behind the curve in terms of interest rate cuts, although the majority of the market seems to be saying that?
You have this interpretation on the market, and it's the best proof is what is happening on the bond market. When you look at the reappraisal of the 2-year yield now, which is close to 3.8 this morning, and it comes from more than 4%, close to 5% beginning of the year, the market is telling you that the Fed is behind the curve. Maybe the market is exaggerating. It's exaggerating the fact that the Fed is behind the curve. It relates again to the issue, are we out of the soft landing scenario? Are we now nearly into a recession scenario? Goldman Sachs came out over the weekend with a study, a research saying, okay, we increase the probability of a recession from 15 to 25%. Yes, they increase the probability, but it's not the main scenario. They still believe, and I strongly believe in that too, is that for the time being, you can see that there is an economic slowdown in the US. That's sure, and that was expected. Do we have a recession that justified to say the Fed is behind the curve? I think it's not that obvious.
Is there any proof that the Fed's objectives for inflation are being met, and what would be the consequence if that was not, if their objectives were not being met?
It's a very good question. I think that first of all, the goal is not yet met, and it will take time. That's obvious. The same way inflation, when inflation comes up, gets up, and goes up, it's something that takes time, and to cool down things, it takes time. The trend is moving in the right direction. Recent numbers in terms of inflation are telling you that we are moving closer to the target, but the target is not going to be reached in the next 3 months, not even in the next 6 months. It will take time. So it means that what you need to keep in mind is that with the market repricing the story of the Fed being behind the curve and some expecting 125 basis point cut by the end of the year, if suddenly you have a bad inflation numbers, it could reignite the fear of a stagflation in the US. And that's something that would be very bad for markets, because we already have currency volatility, we have equity volatility back. It could reintroduce bond volatility, and it could feed into general volatility on the market. So the best we can hope is that inflation is not going to go up again in the coming months.
Thank you, Francois. I think that's all we've got time for. Thank you for joining us. Bye-bye.
You're welcome. Bye-bye.